All right, only two left. We have now the interest expense and tax expense left. So starting with interest expense, obviously this is going to be based on the amount of debt and the interest rate. And so what we've looked at is, in this case, using kind of a weighted average annual interest rate. So this short-term debt balance, might be made up of, 300 million of, 2%, 300 million of, 3.15%, and, another 300 million of 4%, right? So we could model this out separately and have each of the different debts individually listed. It's a lot more work, and we really don't necessarily need that specific level of detail. Again, the total interest expense, this is not going to be the largest item on our income statement by far, right? And so if we think about that Pareto approach to how we forecast, it really makes a lot more sense to spend more time and have more focus in our model on larger items like these, marketing expenses, like the salary expenses that we saw were quite large earlier. Whereas spending a lot of extra time and building in a lot of additional functionality for something that ultimately is a pretty small impact on our financial statements probably isn't the best use of time. And so in this case, we'll go ahead and just take, what is the weighted average annual interest rate. And then, so this is an input. This is going to be a reference to the balance sheet. And again, we'll replace this with the forecasted balance sheet short-term debt balance. But for now, I have this hard-coded just so we can run through the calculation. And so we have this annual interest rate, but we want to go ahead and calculate this to a monthly interest rate on the debt. So we'll take the average interest rate divided by 12. We use this locked cell reference to make sure that as we drag it across, that reference stays the same. And then we can use that as our interest rate moving forward. Now, we could also, because a lot of times when we're doing these internal company forecasts, we'll actually have the information specifically on when the debt balance is due, like when these debt payments are due. So rather than having, 2.4 million or 3.2 million across 3 months, it might all be bucketed just in September, right? And oftentimes it is. These debt balances, the interest is usually paid on a semi-annual basis, so twice a year. And so if we actually know when these specific payments are due, we could build that in. And in some situations, we absolutely would want to do that. If we needed to know specifically when these interest payments were due, we would need to factor this in for cash flows and when we need to plan on actually sending this money out to the lenders. We might want to add that level of detail. Now, in this model and for what we're using for, it's not quite as important. So in this case, we just kind of take this simplifying assumption. And all of this is to say, this is part of why in the course we talk about understanding the purpose of the model, understanding who it's for, and then how that really guides your approach to how you build out your model. What level of detail, what types of options, or what types of flexibility you want to build into your model. It's going to really depend on what the purpose of the model is. Now, let's say taking a different approach than what we have here is we have a really high debt balance. We have, some really urgent cash shortages or considerations. Then all of a sudden, these items that influence our cash flows then all of a sudden become a lot more important. And the small variations that we see could actually have a big impact on what is going on with our cash flows. Knowing how we want to use that model, then it might make sense for us to build in this kind of more precise debt modeling. So a little bit of a segue there, but I feel like it's important to talk about how the way that we approach modeling, what we're using these models for, we can see this translated into actually how we build out our model, like the things we decide to include versus exclude. With that, we come back. We have our average interest rate on debt. And what we're going to do is we have the interest expense. This would be a given. This beginning short-term debt balance is what's going to be driving this interest expense. So I guess if we just wanted to run a check on this, is that we could take this interest expense divided by the total debt balance. And what we see here is that we get to 2625. That's pretty close to what we have there as the kind of weighted average interest rate at a monthly level. So nice little check, makes sense. Get rid of that. And so moving forward, we need to make an assumption around what we think the average monthly interest rate on the debt will continue to be. So if we think that for whatever reason, financing is going to become more expensive, we might build in an increase in the interest rate that we use to forecast our interest expense. In this case, it looks pretty stable. So maybe what we'll do is we'll just take this same equation, copy it across. Now we're making an assumption that the interest rate on the short-term debt is going to stay at the same 3.15% annual interest. Copy this across, paste special. Formula is a number of formats. And so in this case, we see it keeps the input that we wanted to see there, the input formatting that we wanted to see there. Now we can take our short-term debt balance, we multiply it times the monthly interest rate on the debt, and now we have our forecasted amount of interest expense that will change depending on what we set as our assumption around interest rates, as well as the actual debt balance itself. If debt increases or decreases, now our forecast of interest expense will automatically pick that up as well. Copy that across. Now we come back. We're going to basically do the exact same thing with the long-term debt balance. Do the same calculation here. Let's take weighted average annual interest rate, lock the formula, divided by 12. So we see our long-term debt balance has a slightly higher interest rate. This is not uncommon. The longer the term of the debt, typically it has higher interest rates. So as we move into longer-term debt from shorter-term debt, we would expect the interest rate to be a little bit higher. Okay. Now we have this given long-term interest expense. Again, we could do, just to be safe, do a little check here. Say, what if we took our long-term interest expense and divided by that total debt balance? We're looking at 0.35%, which is basically what we're seeing here. Perfect. Good check. Now we can come over to our forecast period. And again, let's make the assumption that the interest rates are going to stay roughly the same. So we'll copy the same equation across, paste special, formulas number of formats. Now back in our first forecast month, we're going to calculate our long-term interest expense. The debt balance times the monthly interest rate. And here we have our long-term interest expense forecast by month. Copy that across the same way we just did. So now we have interest expense, both short-term and long-term. Oftentimes these are just going to be grouped together on the income statement. And so to kind of facilitate that, let's add in a summary for short-term and long-term interest rate for our total interest expenses. And we'll go ahead and copy that all the way across for both the historical and the forecasted period. All right, now last we have our tax expenses. Now, our tax expenses are going to be based on our pre-tax operating income. This is going to be the total of revenue, less all of the cost of sales and operating expenses, including our total interest expense, which we'll pull together in a summary tab called the summary income statement. We'll pull that together in a little bit. Once we have our revenue forecast completed, we'll kind of summarize that in the summary income statement. And as part of that, we'll calculate the pre-tax operating income, in which case we'll come back here and we can link that directly to and back into the model. But for right now, this is, again, going to be a hard-coded value. And so I've made a note here that we have this hard-coded from summary income statement and replace with the link, which is why this is a green cell. We also have total tax expenses. These are given. We know how much we've paid to the IRS or other taxing authorities. So what we're going to look at is what percentage of our pre-tax operating income do we ultimately have to pay out in taxes. So we'll take total tax expense divided by pre-tax operating income, and that gives us what seems to be a nice, almost fictionally clean 21% every single month. Considering just how stable this tax rate is, I think it's pretty safe to say that the 21% is what we would likely be using moving forward. So again, we can take this as a point estimate. We can take an average. Doesn't seem like it would really matter. Let's go ahead and we'll just take this as a point estimate. And we'll just say each of these months is the same as the month before it. Okay, pull this across and then come back over, and we're going to calculate now what is our tax expense based on our pre-tax operating income multiplied times our forecasted effective tax rate, and that gives us our estimated total tax expense. Fill that all the way across, do Control R, copy it across.